Silicon Valley Bank, a well-known institution in the technology hub of the United States, has collapsed due to a liquidity crisis, resulting in the largest bank failure since Washington Mutual in 2008, and the second largest in U.S. history. Despite its 40-year history, the bank was shut down by the FDIC on Friday after losing $2 billion and failing to raise the required capital. Before the bank's collapse, CEO Greg Becker explained the need to raise capital, as over 50% of the bank's assets were in bonds, which were being affected by higher interest rates and a slowing economy. In response, the bank's stock fell over 60%, leading to its eventual shutdown. The bank and its clients had been squeezed by higher interest rates and a slowing economy. The Federal Reserve has raised interest rates 8 times since 2022, and another hike is expected at the March 22 meeting. This has created an environment where banks cannot shift quickly enough, leading to potential contagion and more bank failures. The Silicon Valley Bank's failure is seen as a management failure due to the bank's poor management of its Tier 1 capital, which was heavily concentrated in one asset and had a narrow client base limited to Silicon Valley tech companies. The collapse has raised concerns about contagion, with S&P 500 financial stocks falling 8.5% and the KBW Bank Index, which contains mid-sized and regional banks, falling 15.7% this week. The Federal Reserve's actions to combat inflation may need to be fundamentally rethought, as the current policies may lead to financial instability and a recession. Customers of Silicon Valley Bank with insured accounts will have access to their money on Monday, but the value of assets above the insured threshold is still unknown.